The stock market just hit another record high. GDP is growing, unemployment is sitting near historic lows. Every official measure of the American economy is pointing in the same direction, up. And yet, consumer sentiment just hit one of its lowest readings in decades. Americans are carrying $1.3 trillion in credit card debt. The personal savings rate has fallen to around 2.6%, near the lowest level ever recorded. And according to the Bureau of Labor Statistics, the savings rate for the bottom half of the country is not just low, it is negative, which means more than 65 million households are spending more than they bring in every single month. So which is it? Is the economy strong or is it broken?
The answer is both. And that is not a contradiction about the American economy in 2026. Because what we are living through is not one economy performing well or poorly. It is two economies occupying the same country at the same time. One is measured by the data. The other is felt in your wallet. And the reason they keep telling different stories is that they are tracking completely different things for completely different people. Today, we are going to explain exactly why. No spin, no politics, just the mechanism. To understand the split, you first need to understand what the official economic numbers are actually measuring. Because most people assume GDP, market returns, and unemployment figures are measuring something like the average person's financial well-being. They are not. GDP measures the total value of goods and services produced in the economy. It doesn't measure how that value is distributed. A country where one person earns $1 billion and 1 million people earn nothing has the same GDP contribution from that billion as a country where 1 million people each earn $1,000. The aggregate looks identical. The lived experience is completely different. This distinction matters enormously right now, because the United States has been producing significant aggregate economic output while simultaneously concentrating the gains from that output at the top of the income and wealth distribution at a pace that has no modern precedent. GDP goes up, the number is real, but if the majority of those gains flow to households in the top 20% of the wealth distribution, then the GDP number describes an economy that 80% of the country is not meaningfully participating in. And that is not a hypothetical. That is exactly what the data shows. Let's look at the numbers that the headline figures are not showing you. Start with the stock market. The S&P 500 is up over 120% since 2020. By any measure, that is an extraordinary run. But who actually owns the stock market? According to the Federal Reserve's own data, the wealthiest 10% of American households own approximately 87% of all stocks. The bottom 50% of the country owns about 1% of the stock market. Not 1% each, 1% combined, split between roughly 67 million households. Which means when the market goes up 20% in a year, the wealthiest 10% capture almost all of that gain. For the bottom half of the country, a 20% market return produces a paper gain of a few $1,000s at most. For a household in the top 10%, that same 20% return might produce $100,000 or more in a single year. Same market, same return percentage, completely different financial reality, depending on where you sit in the wealth distribution. Now, look at wages versus inflation. Over the last 4 years, average hourly earnings in the United States are up about 20%. That sounds like a raise. Except over that same period, the consumer price index is up approximately 21%, which means the average worker's raise got entirely consumed by inflation before it ever reached their standard of living. They earned more in nominal terms and lost ground in real terms, simultaneously. And that 21% CPI figure is itself an understatement of what the experience feels like for most Americans. Because CPI is a weighted average across all spending categories, and the categories that have inflated most aggressively are not optional. They are the essentials. Groceries are up over 25% since 2020. Housing costs are up over 30%. Car insurance has risen nearly 50% in 3 years.
And healthcare, which the Bureau of Labor Statistics tracks separately from general CPI, has consistently inflated at roughly 1.5 to 2 times the general rate for the past 2 decades. So the official inflation number says prices are up 21%, but the prices of the things you cannot choose not to buy, food, shelter, transportation, healthcare, are up significantly more. The official number is technically accurate. It just does not describe the inflation most people are actually living.
Now here is the data point that ties all of this together: consumer sentiment. The University of Michigan has been measuring consumer sentiment since the 1950s. It is one of the longest-running surveys of how Americans feel about their personal financial situation and the broader economy. And in 2024, despite GDP growth, despite record stock market highs, despite low unemployment, consumer sentiment fell to readings that were lower than during the 2008 financial crisis and in some measures lower than during the pandemic lockdowns of 2020. Think about what that means. People felt worse about their finances during a period of nominal economic growth than they did during the worst financial crisis in a generation.
The standard explanation from economists and media commentators is that people are irrational, that they are letting negative news bias distort their perception of an objectively good economy, that they are feeling bad about something that is actually fine. But there is another explanation, a simpler one. People are accurately reporting their own financial experience, and their financial experience is not the same as the aggregate economic data, not because they are confused, but because the aggregate data is measuring something different from what they are living.
So why does this divergence exist? What is the mechanism that allows the economy to grow on paper while feeling stagnant or worse for a significant portion of the population? There are 3 structural forces driving this split, and understanding all 3 is the difference between blaming yourself for not getting ahead and understanding the system that determines who gets ahead and who doesn't. The first force is asset price inflation versus consumer price inflation. When the Federal Reserve cuts interest rates or injects liquidity into the financial system, that money does not flow evenly into the economy. It flows first and fastest into financial assets: stocks, real estate, private equity. Asset prices inflate. And because asset ownership is extraordinarily concentrated at the top of the wealth distribution, asset price inflation disproportionately benefits the people who already have the most. For someone who owns a home and a stock portfolio, low interest rates and quantitative easing are a wealth creation machine. Their assets go up. Their fixed-rate mortgage stays the same. Their net worth expands while they sleep. For someone who rents and has minimal savings, the same policy environment produces a different outcome entirely. The assets they do not own go up in price, making them more expensive to acquire. Their rent rises as housing costs inflate. Their wages may tick up slightly, but not fast enough to offset the rising cost of everything around them. The same monetary policy that made one household significantly wealthier made another household slightly poorer. Not because of anything either household did, because of which side of the asset ownership line they were on when the policy was applied. The second force is the divergence between wage growth and productivity growth. Between 1948 and 1979, wages and productivity in the United States grew at roughly the same rate. Workers became more productive, they got paid more. The gains from economic growth were distributed relatively broadly. Not perfectly, but broadly. Starting in the early 1980s, that relationship broke down. Productivity continued to grow. Workers continued to produce more output per hour worked, but wage growth flatlined relative to productivity. The gains from increased productivity stopped flowing primarily to workers and started flowing primarily to capital, to business owners, shareholders, and executives. According to the Economic Policy Institute, if wages had kept pace with productivity growth since 1979, the median American worker would be earning approximately $25 more per hour than they currently are. That is not a small gap. That is the difference between the economy feeling manageable
and the economy feeling impossible for a significant share of working Americans.
The productivity happened. The output is in the GDP number, but the distribution of that output shifted away from labor and toward capital over 4 decades. And that shift is structural. It did not happen by accident. It happened through a series of policy decisions, labor market changes, and corporate governance shifts that consistently prioritized returns to shareholders over compensation to workers. The third force is the financialization of the economy. And this is the most abstract of the three, but arguably the most consequential. Financialization is what happens when the financial sector grows faster than the underlying productive economy it is supposed to serve. When more and more economic activity and corporate profit comes not from making things, providing services, or employing people, but from financial engineering, debt restructuring, stock buybacks, mergers and acquisitions, derivatives trading. In 1980, the financial sector accounted for about 4% of U.S. corporate profits. By 2024, that figure had grown to over 25%. 1/4 of all corporate profit in America now comes from financial activity rather than productive economic activity. And financial activity, almost by definition, rewards people who already have capital to deploy. You need money to make money in a financialized economy. You need assets to leverage, positions to take, instruments to buy. The person with a $500,000 investment portfolio participates directly in the gains from financialization. The person living paycheck to paycheck does not. They are not playing the same game. This is not a moral argument. It is a mechanical one. The economy has been restructured over decades in ways that systematically generate returns for capital and suppress returns for labor. And the official economic metrics, GDP, market returns, unemployment, measure the aggregate output of that restructured economy without capturing how the gains are being distributed within it. So come back to the original question. Why does the economy look fine on paper and feel broken in real life?
Because the paper is measuring aggregate output, and real life is experiencing distributed outcomes. And in an economy where asset ownership is concentrated, where productivity gains flow to capital rather than labor, and where the financial sector captures an increasing share of total profit, those two things will always tell different stories. The record stock market is real. For the 10% of households who own 87% of stocks, it is genuinely meaningful. Their net worth has expanded substantially. The economy, by the only measure that touches their daily life, is doing well. The credit card debt is also real. For the tens of millions of households financing groceries and utilities on 23% interest credit cards, the economy is not an abstraction. It is a monthly deficit.
Both economies exist. Both are accurately described by their respective data. They just describe completely different populations living in the same country at the same moment. And the reason this matters is simple. If you are trying to make financial decisions based on economic headlines, you are using data that may have nothing to do with the economy you are actually living in. The GDP number does not tell you whether your wages will keep pace with your costs. The stock market record does not tell you whether your savings rate is positive or negative. The unemployment figure does not tell you whether the job you have pays enough to build any real financial cushion. You need to know which economy you are in, not the aggregate one, the one that describes your specific position in the wealth and income distribution. Because that economy, your economy, is the only one that actually determines your financial future. And the traditional financial media will not tell you that, not because they do not know, but because explaining the structural divergence between aggregate economic data and distributed financial outcomes requires acknowledging things that are politically and institutionally uncomfortable to acknowledge. So if you want to understand the economy you are actually living in, not the one on the front page, hit subscribe, because that is exactly what this channel is built to do.